Hey, gang, this is Carl White, and I am broadcasting here from the studios. And you are listening to the Author Showcase, a podcast sponsored by the Scotsman Guide. And today I'm the co-pilot, called the pilot in command is Mr. Charles Goodwin, coming out of San Diego, California. He wrote a great article in the Scotsman's Guide. Again, this was the residential edition called Get in the Game. So, Charles, man, thanks for being here today. Good to see you here, my brother. And tell us a little bit, kind of briefly introduce yourself a little bit,
Sure.
and and your experience in the realm of what we're talking about here today, which is condo investments.
Sure. Well, first off, thanks for having me. Very excited to be here. Quick intro. My name's Charles Goodwin. I work for Kiavi. I'm the Senior Director of Sales here. Kiavi, we're a mortgage lender for residential real estate investors. So we work entirely in the non-owner occupied, non-conventional private lending space, I guess you could say. And what makes Kiavi unique is I would say we take a focus on using data and technology to provide lending solutions for real estate investors of all sorts that are fast, easy, and reliable. So that's a little bit about me.
Nice. So, give us a 30,000-foot view of what the article. And by the way, if you have not read the article, I highly recommend it. So I read it earlier today, and really good information. Definitely out of the box, right? Definitely out of the box. Which it's nice to have those arrows in our quiver, for our work. So, give us a 30,000-foot view of what Get in the Game was written about.
Yeah, so the article talks about condo DSCR loans. And for those that aren't familiar with DSCR, that stands for debt service coverage ratio, which that essentially, the easy way to think about it is the ability of the rents from the property to pay for the debt, to pay for the mortgage. So it's the rents divided by the principal, interest, taxes, insurance, and association fees. So that's really, what the main point of the article was about. And I guess a simple way to say is it's an underwrite that's based more on the property as opposed to the individual borrower itself.
Very interesting. I'll be honest with you, until I read the article, I didn't know such things existed. So I thought it was
Why we're talking.
I beg your pardon?
So that's why we're talking now.
That is, and that's why you're the author of this magazine, and I'm the guy. I'm the dude asking questions. So, how long have the DSCR type loans been in existence? Brother, I have closed tens of thousands of loans in my career.
Yep.
I've never heard of, which doesn't mean anything, but I've never heard of them. So, is this a new thing, or has this been around a long time and I had my head?
Yeah. It's a great question. They have been around for a while, but they really only started scaling, post the great financial crisis. So, in call it 2012 and 2014, when you started getting into that recovery phase, you started seeing lower interest rates in general, lower cost of money. That's really when this private lending space and residential lending, really started growing. And it's grown quite substantial over the past several years. Kiavi itself, or Kiavi just alone, will do over $4 billion in loans just on residential properties this year.
Very interesting. So why do you think, and maybe you covered it a little bit here just then, but why do you think the DSCR loans are gaining traction here? Like what's is it just that more and more people become available, or is there more and more funds being funded into it for us to loan out?
Yeah, there's definitely been a lot of money that flowed into this space, especially post-COVID. But I would say the reason why this space is growing so much is because they serve a need, they serve a purpose. And the way I view of what need that these types of loan products fill is they help a real estate investor scale. So the way I would think about it is there's three main benefits of a debt service coverage ratio loan. So one, for example, is that they can be financed in an entity. So we actually only lend to companies. So things like LLCs and corporations. And that helps limit an investor's personal liability. Another reason why these are very beneficial is because they generally aren't reported to credit bureaus. They're done in private loans to entities, so they're not reported to credit bureaus. And the big benefit of there is, you are limited to 10 conventional mortgages on your personal credit report. So if you're hoping to scale, that may cause a challenge. And then finally, I think a big benefit of these is that they're really just based on the property itself as opposed to the borrower. So, for example, we are not underwriting debt to income or collecting reserves, for example, on these loans. So they really do serve a purpose in this niche space that helps investors scale.
Interesting. So are there, and I guess you've already listed off a couple of them here, debt to income and not looking at reserves. Are there any other differences in the loan approval process of a DSCR loan as opposed to what most of us are used to, Fannie, Freddie, VA, FHA?
Yeah, so a reason why I love these loans is because it's a very simple underwrite. So we, for example, we do look at a borrower's credit score, but beyond that, it's entirely based on the property itself. So the way the underwrite works is we'll order a traditional appraisal, which will give us a value of the property, but we'll also order an attachment. For example, on a single family home, it's called a 1007 attachment, which that is an appraisal of market rents, not just the value of the property. And those rents from the appraisal are what we're going to use to determine that debt service coverage ratio.
Very interesting. Man, this sounds like a really hot thing. So how can loan officers best educate potential investors about the benefits of these DSCRs over traditional loans? How do we get the word out?
Yeah, well, a great way to do it is by going to Kiavi. Kiavi posts all sorts of blogs, helpful ebooks, e-learning content, things on our socials, all sorts of things like that can help get the word out of these loans. There's always several big national investor conferences that many folks in the mortgage broker space go to. So all sorts of things like that are a great way to just go online and educate yourself. And of course, if you call into Kiavi, we'd be happy to help.
Now, in this particular article, you talked about, I think you kind of mainstream toward the condo type investments, but these DSCRs, they can be on single family residences, duplexes, I guess virtually any type of property. Is that correct?
Correct. Yeah, we primarily lend to 1 to 4 unit residential properties, so duplexes, triplexes, quadplexes, single family condos, PUDs, all sorts of property types just in the residential space. And debt service coverage loans also, exist outside of the residential space as well. Very common type of underwrite in small multifamily commercial type of loans as well. Yeah.
Yeah. You also mentioned, and correct me if I'm wrong, that this on the guidelines for condos. Let me just ask you. So, is this for warrantable and non-warrantable, or is it just one in particular?
Yeah, it's a great question. So Kiavi only lends to warrantable condos. There are many lenders that will lend to non-warrantable condos, which I can talk about some of the differences and things to look out for. For example, if you're a mortgage broker trying to educate your client or help set them up for success, certainly things that I can help somebody look out for, I guess you could say. But yeah, we only lend to warrantable condos, but that does not mean that financing for non-warrantable does not exist. It's definitely out there in the market.
And if we have like a newer loan officer that might be listening to this today, because certainly there is, we all started at some point. Is there how can a loan officer quickly discover, is this warrantable or non-warrantable? If they want to find out which they are, what do they just call the HOA and ask them?
That certainly is a way you can do it, right? If you're local, you can go walk around and ask somebody. But an easy tool that Kiavi actually uses is Fannie Mae hosts an online tool called Condo Project Manager that Kiavi uses. And Kiavi will go online as soon as we have an address of a property and check out the project name and see if it's on the list of approved or unimproved projects. And, if it's on unapproved list, that certainly will very likely result in the project ultimately being non-warrantable. So we do have a way to check for it up front, and it's highly encouraged to do so because that certainly can make a difference on eligibility entirely. And then some lenders, like I mentioned, will lend on warrantable and non-warrantable, but there often are differences in loan to value ratios on whether a condo is warrantable or not.
All right, got it. And I know there was another thing in the article you mentioned about using third-party analytic reports
Yep.
for the HOAs. Are there any specific platforms or companies that you'd recommend for getting that?
Yeah, we use a company called Condo Analytics, and they are very helpful because the guidelines to determine warrantable versus non-warrantable aren't super straightforward. I was Googling Fannie Mae's website this morning, and there are actually several different eligibility rules versus what would make something ineligible. And the company that we use, Condo Analytics, helps do kind of that, I'll call it an underwrite of the homeowners association. So, for example, some of the common ones that we run into that are certainly things to look out for is that for it to be warrantable, more than 20% of the units cannot be owned by a single entity or individual or investor. So that is a big one that you'll run into, and especially in vacation areas sometimes, things like that. Another one that we see is if the condo association is involved in maybe unresolved litigation, or they don't maintain an adequate level of reserves, or maybe there's significant repairs that need to be done to the association, things like that.
Yeah. All right, got it. How about yeah, I remember in the article you also mentioned, which by the way, again, I want to, if you're listening to this, make sure you go to scotsmansguide.com and look under the residential side and look up this article, get in the game. So really good read. You mentioned in the article also about whether the property is rented via Airbnb versus long-term rentals. Can you talk a little bit about that?
Yeah, that is a great question. It certainly will come up in conversation with many investors, and happy to speak to a little bit about it. So most lenders will not do a DSCR underwrite from the perspective of short-term rents, right? And that can drastically change your equation and your eligibility for your loan in general. And to speak to a few reasons why is what I personally think is there is a lot of regulatory risk involved with short-term rentals, right? There are all sorts of articles popping up on how certain municipalities are restricting or cutting off eligibility. Just 2 months ago, there was a big one. The city of Dallas put out approved a ban on short-term rentals in residential areas. So if you're curious as to why a lender might be more hesitant to lend on something like a short-term rental, that's great proof as to why. The other reason is just volatility, right? Seasonal rentals, there's certainly a lot of volatility in the rents you might collect and when. And, on top of that, the regulatory risk is just something to be careful about.
Yeah, got it. Yeah, we're noticing out here in my area. I'm in the Tampa Bay area, and noticing the same thing that, last year it was okay. This year it's not. So it'd be risky for the investor.
Yeah, it's happening. Palm Springs is right down the road from San Diego, 2-hour drive or so. And just about every municipality in that Palm Springs, Coachella Valley has outruled them. You can still do it with restrictions in Palm Springs, the city, and the city of Indio, but basically everywhere in between, there's full bans on them these days.
Yeah. Are there any potential risks that loan officers should be wary of when they're looking at this DSCR type loans? Any risks the loan officer should be aware of?
Yeah. I mean, to be truthful, the DSCR loans aren't for everybody. To talk about some of the pitfalls or things to be aware of is, a simple one that I was thinking about this morning is not all investors buy for cash flow. Many do, but some do not. For example, higher price point properties here in San Diego is going to be very hard to make it cash flow from day one unless you put a substantial amount of equity down. And these loans are, by virtue of its name, an underwrite of essentially your cash flow. So, that's a big one to be aware of. It's a specific investment strategy. I would say the other one to be aware of is, they are appraisal based, and anybody who's been in lending know that appraisals, sometimes you get good ones, sometimes you get not so good ones. And particularly with DSCR, we see variation in market rents. Market rents are not as available of data compared to things like sale prices. So, don't get me wrong, it's definitely available, but just something to think about when you're going into a DSCR loan is that the way Kiavi does it, and where many lenders do, is there's that overlay of market rents.
Yeah. One last thing as we kind of wrap this up here today, for the mortgage loan officers that might be listening to us today, give me a take home thing. Like what's your number one piece of advice for helping them grow and thrive in this niche market that we're talking about here? Give me one takeaway.
Yeah, I would say my main takeaway is that you can help your clients scale by using debt service coverage ratio loans. And as we have already mentioned, many folks aren't even aware that these types of loans exist. So if you're educating your clients properly and setting expectations, and you can help them understand the benefits of these loans, your clients can look to you as, a trusted advisor, right? And that can create a great mutually beneficial relationship.
This kind of reminds me, I've got a dear friend of mine that's a loan officer, very, very, very successful, got into the business, was brand new, and came out of the gate just cranking out some serious volume. And I know serious volume. This was some serious volume. And what she used was the reverse mortgages as a purchase niche. And she did her fair share of those, I suppose, but just it was a product that set her apart, that all these real estate offices wanted her to present in their real estate offices as some content to teach their real estate agents. And then she took that introduction, taught the class, and then worked her magic and got the people to start referring, not just that product, of course, but by far mainly other products as well. And so having that unique thing that makes you kind of stop in track, wait, what is that again? What's that? Very, very, very clever. So good. It definitely looks like it answers a big problem.
It's an extra arrow in the quiver is a way to think about it.
Yeah, I really like it. So good. Hey, Charles, is there something I should have asked you today that I didn't? You know way more about this than I do. Anything I missed today? You think we covered it okay?
I think we covered it great. I would say, I think what was probably on a lot of people's minds in general is do the single family rents or condo rents, does kind of the overarching or macro outlook seem good with where interest rates are at the moment, right? It's no secret that the underlying interest rates have gone up 5% or more, across all sorts of different types of financing. And I'll tell you, my view of it is that, yes, despite, yields or your cash flow being compressed at the moment a little bit, I still believe there are strong housing fundamentals to support growth in this residential, real estate investment space. And specifically, those are today, the cost to own far exceeds the cost to rent on a national level. So what I think that will do is that will drive more people to continue renting, which should help investors' rent growth.
Yeah.
And then, the other thing I would say is there's still an undersupply, unfortunately, of homes in this country. And that should provide a little bit of a price floor on value. So that's the other thing to think about. Again, just my view. Not everybody's going to agree with that one, but it's just something that I think about.
All right, real good. Charles, again, thanks so much for coming on here today. I really appreciate it. If somebody wants to reach out to you and get more information, is there a website or something they can go to learn more about you and your company?
Yeah, thanks so much for having me. It was a fun conversation. You can find me directly on LinkedIn. If you just look up Charles Goodwin, Kiavi, you'll be able to find me easily. And then Kiavi.com, that's KIAVI.com. That is where you can find our company. So thanks again.
All right. Outstanding. All right. Thanks again, Charles. Hey, for our listeners, we really appreciate you guys. And boy, we're going to ask you a couple of favors. Number one, take this episode and forward it to 3 of your friends. We promise you they'll appreciate it. And certainly we will too. And again, we always appreciate those honest reviews. So just obviously we like the 5 stars, but just an honest review. We certainly appreciate that. That helps the algorithm get the message out. So my name is Carl White. And on behalf of the Scotsman Guide Thank you so much for being a part of the Author Showcase, and we'll talk to you on the next episode. Thanks again, everybody. Bye-bye.